Stock market meltdowns. They're the stuff of nightmares for investors, causing sleepless nights and endless worry. Imagine waking up to find that your investments have lost significant value overnight. It's a scenario that sends shivers down the spine of even the most seasoned investors. Picture this. Stock prices plummet rapidly, and the market is in chaos. Fear grips the market. Everyone is selling, and no one is buying. Panic spreads like wildfire, and the value of your carefully crafted portfolio takes a nosedive. Your financial future seems uncertain, and the hard work you've put into building your investments feels like it's unraveling. We've seen this before. Remember Black Monday in 1987? The Dow Jones Industrial Average plunged nearly 23% in a single day. It was a day that left an indelible mark on the financial world, a stark reminder of the market's volatility. Or the financial crisis of 2008, when the market went into freefall. The ripple effects were felt across the globe, shaking economies to their core. Meltdowns are a stark reminder that markets can be volatile. They're often triggered by a combination of factors: economic shocks, bursting bubbles, geopolitical events, you name it. Think of it like a sudden storm, wreaking havoc on the market landscape. The unpredictability can be daunting, but it's an inherent part of the financial ecosystem. But here's the thing. While scary, meltdowns are a natural part of the market cycle. They're like earthquakes. We know they'll happen, but we can't predict when. Understanding this can help investors prepare and navigate through the storm, emerging stronger on the other side. So, while we can't predict the exact timing, we can certainly brace ourselves and stay informed, ready to weather the next market storm. Let's take a trip down memory lane, back to some of history's most infamous market meltdowns. These events have shaped the financial world as we know it today. Remember the dot-com bubble burst in the early 2000s? It was a time of great optimism and rapid technological advancement. Tech stocks, once considered invincible, came crashing down to earth. Companies that seemed unstoppable were suddenly worthless. Investors who had poured their life savings into speculative companies were left reeling. The financial landscape was forever changed. Then there was the Asian financial crisis of 1997. It was a stark reminder of how interconnected our world had become. It started with a currency crisis in Thailand and quickly spread like wildfire through Asia, affecting economies far and wide, causing stock markets to collapse. The ripple effects were felt globally, shaking investor confidence. It was a stark reminder that global events can have a ripple effect on markets worldwide. No economy is an island. And who could forget the Great Depression of the 1930s, the granddaddy of all market meltdowns? The granddaddy of all market meltdowns, it was a period of unprecedented economic hardship. Families were torn apart by financial ruin. The stock market lost nearly 90% of its value, leading to widespread poverty and despair, leaving millions jobless and struggling to survive. The social fabric of the nation was tested like never before. These historical examples, while painful to revisit, teach us valuable lessons about the cyclical nature of markets. They remind us of the importance of resilience and the importance of staying calm in the face of adversity. History has shown that markets do recover, and so do we. When the market tanks and your portfolio is bleeding red, it's tempting to hit the panic button and sell everything. But trust me, that's the worst thing you can do. Why? Because selling into a panic means you're locking in your losses. Remember, stock prices are based on supply and demand. When everyone is selling, prices plummet. If you sell at the bottom, you're missing out on the eventual rebound. Think of it like this. You wouldn't sell your house at a fire sale, would you? Of course not. You'd wait for the market to recover before selling. The same logic applies to stocks. Panic selling is driven by emotion, not logic. And in the stock market, emotional decisions are rarely profitable. So take a deep breath, resist the urge to panic, and stay the course. Section 4. Steady as she goes. A long-term perspective. Remember, investing is a marathon, not a sprint. It's about endurance, patience, and staying the course even when the going gets tough. Market meltdowns are like unexpected detours on your journey to financial freedom. They can be frustrating and unsettling, but they are also a natural part of the investing landscape. They might slow you down, but they shouldn't derail you from your long-term goals. Just like a marathon runner faces hills and valleys, investors face market ups and downs. Instead of panicking, view meltdowns as opportunities. These are moments to reassess and potentially strengthen your portfolio. When prices drop, it's like a clearance sale for stocks. This is the time to look for bargains and invest in quality companies at lower prices. You can buy high-quality companies at a discount, increasing your potential for long-term gains. This strategy can significantly enhance your portfolio's performance over time. Think of legendary investor Warren Buffett. He has navigated numerous market cycles with a calm and steady hand. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This wisdom has guided many successful investors through turbulent times. In other words, don't be afraid to buy when everyone else is selling. This contrarian approach can lead to substantial rewards. The key is to focus on the long game. Just like a marathon, investing requires stamina and a clear vision of the finish line. Don't get caught up in short-term market fluctuations. These are just temporary blips on the radar of your long-term financial journey. Stay invested, ride out the storm, and let the power of compounding work its magic over time. Remember, the journey to financial freedom is a marathon, not a sprint. Section 5. Don't put all your eggs in one basket. The power of diversification. You know the old saying, don't put all your eggs in one basket? Well, it's true for investing too. Diversification is key to weathering market storms. Think of your portfolio like a well-balanced meal. You wouldn't want to eat only one type of food, would you? Similarly, you shouldn't put all your money into one stock, industry, or asset class. Spread your investments across different sectors like technology, healthcare, and financials. Consider investing in different types of assets, such as stocks, bonds, and real estate. Diversification helps reduce your risk. If one investment performs poorly, others can help offset those losses. It's like having a safety net for your portfolio. Section 6. Opportunity and chaos. Finding value in the rubble. Market meltdowns often create fantastic buying opportunities for savvy investors. When prices plummet, it's like a treasure hunt for undervalued stocks. But how do you find these hidden gems? First, focus on companies with strong fundamentals. Look for businesses with solid financials, experienced management teams, and a history of profitability. Second, consider companies that are well-positioned for the future. Think about industries that are likely to thrive in the long term, such as renewable energy, artificial intelligence, or healthcare. Finally, don't be afraid to do your research. Read company reports, analyze financial statements, and stay informed about industry trends.